Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Hopefully all of you had a very nice weekend so far. Now keep in mind, all these options plays are going to be for selling options, more specifically for selling put options as part of the larger wheel strategy that I like to run on the channel. It's a very easy strategy to run, whether you are a beginner, intermediate, or even advanced investor. Allows us to collect some very nice passive income in the markets, low chart time as well, not too much time involvement there, low risk profile too, and a very high win rate strategy overall. About 90 to 95% of these trades will all result in wins. And the worst case scenario is you end up with shares of your favorite company. So in today's video, guys, we have a few things prepared for you. Of course, number one, we are going to be going over the expectations for the week. We know these recent weeks have been very volatile in the markets, so I figured I should give you a 4 to 5 minute presentation of what we have on the table. Macro news events to pay attention to, possible corporate earnings, and just overall a general overview of technical analysis on the SPY and the QQQ. Are bounces possibly in order? We'll take a look at that in just a few short moments. Thereafter, we're going to take a look at these strategy rules. What do I look for when looking to sell puts in the market? Basically, they are buy limit orders that pay you. Very easy to understand. So we'll go over a few of those strategy rules. And then, of course, lastly, go over the top 5 options plays. And as usual, I have a bunch of bonus plays for you as well. So make sure you stick around to the end. Without further ado, let's jump right into the action, shall we? So in terms of the expectation for the week, let's look at the macro first. What do we have on the table? Well, we start off with a banger on Monday, manufacturing data. And this one is going to come in under the expectation. We know that manufacturing has been front and center because we are talking about potential economic weakness on the horizon. If the market does not like this report, we may start off the week on a red note, and that is perfect when we're looking to sell options into the market. Thereafter on Tuesday, not much, a bunch of Fed speakers, but consumer confidence. This has been a pain point over the last 2 months as we go through this new administration's transition effects into the economy. So consumer confidence, if it comes in weaker than expected, which would not be surprising, that too could be a catalyst to bring the markets down a little bit. On the Wednesday session, guys, we got durable goods, not much there. More Fed speakers going to comment on the direction of the economy. Thursday, we get a big GDP report. However, this is the final revised number. We've gotten this number for the past 3 months in a row. Now it's going to be the final number, not expecting many changes because it's largely been priced in so far. On the Friday, we have a big day, core PCE and PCE, the Fed's preferred gauge as to inflation. We are expecting this one to come down in relation to January and February, which pointed to the fact that they were relatively hot months as well. So we'll take a look. Is the February PCE going to be in line with the CPI coming down overall? That is possibly likely going to be the case. And then, of course, we have the Michigan Consumer Sentiment Report, which could move the markets. We know that this one was a big pain point when we got it last month in February. We will see the impacts as well. So in all regards, guys, we got a lot of hard data points, which is actual factual data, these red marks right here, but also the soft data, to use the Fed's terms, the consumer confidence, right, on the Tuesday session and consumer sentiment on the Friday. Those are two things that impacted the market a lot more than they should have last month. So this week could be a little bit of a volatile week combined across all of these economic events. Now, keep in mind, that is perfect for us looking to sell options in the market when we're looking at some of the volatility. In terms of earnings, we don't really have many big earnings unless you're a GameStop fan, right? Other than that, not many big market moving events. Last week, the ones that moved the market were Nike, FedEx, and a few of the travel companies, just guiding for macro uncertainty. This week, arguably the biggest one of the bunch is perhaps Lululemon, arguably on the Thursday after the close. But special shout out to companies such as Chewy and some of the dollar stores as well. Dollar Tree reporting on the Wednesday session, giving us more hints into the health of the consumer overall. So that is your macro, all your macro events for the week to take a look at. In terms of the technicals, though, the technicals, even though we've been coming down for 4 weeks in a row and tried to have somewhat of a bounce on the Friday session, I wouldn't say the markets are looking too bad, especially if you look at the futures, right? The bulls, what they're trying to do is go for the daily uptrend, need to get some momentum, and the QQQ bulls as well, the NASDAQ bulls, also trying to go for the daily uptrend. Keep in mind, though, the weekly bears are in full control of this downswing, and any bounce higher could just be resulting into a lower high, and then it's up to the bulls to recapture into the weekly uptrend. If not, if the bounce is too weak, guys, and we hit the resistance way too fast, could be heading right back to those lows. However, keep in mind, guys, we are in a very nice area of support that the bulls have built over the past 2 weeks on the SPY and over the past 2 weeks on the Qs as well. If we get shot down on the Monday or Tuesday morning, there's going to be some very nice opportunities in the markets to sell some puts to the open. We are looking to sell puts below the market, so any red days will definitely help us get the best possible prices on our favorite stocks well below the current areas in the market overall. So that is just a glimpse into what we can expect on the technicals, guys. Overall, we have a lean for a bounce, but because we have so many hard and soft data points this week, we would not be surprised if the volatility continues into the early portions of the week. And as I said, any red days will be a good opportunity for us as option sellers to jump on those trades immediately Monday or Tuesday for the Friday session. So that is the kind of preview for the week. Another week of heightened volatility. And of course, the week of April 2nd, the week after that, is the reciprocal tariff week, when we finally get Trump's views, or Trump's actions rather, on what he plans to do in terms of implementing tariffs on every single other country that has outsized tariffs on the United States. So that is your preview for the current week. A lot of volatility to be had, that's for sure, similar as what we've had for the last 4 or 5 weeks. Now, in terms of these strategy rules, what do I look for when I'm looking to sell put options? As to begin with, what exactly is a put option selling a put to open? Well, just think of it very simply, guys, as a buy limit order that pays you. It's just that simple, right? Let's say I want to buy 100 shares of Amazon down here into support at roughly 190. There's 2 ways for me to do that. Either I can set a buy limit order here, but if it's not filled and the market just runs away, you don't get paid and you don't get any shares. That is where selling puts comes into play. Take a look at the options chain right here. If I sell a put on Amazon for $190, that means that I'm willing to buy 100 shares at that price if it closes below there on the Friday session. Now, in the event that the market closes above 190, I would just get to collect $103 for placing that order in the market. If the stock closes below 190, I will have to buy those 100 shares, but I'll still get to keep that $1, which will bring my average cost down by about $1 per share for an average cost of $189. So as I said, it's a way to place buy limit orders under the market on high quality, high conviction companies that you're looking to buy anyways. And in the event that it doesn't get there, at least you are getting paid for your time and for your capital as well. That's why I like that strategy. Very passive strategy as well. Let's go through some of the rules, shall we? Now, before I get into them, keep in mind, I have a 30-minute video down below in the description where I go over this strategy in more detail, and I'll also link a second video from early February. I used to do about 10-13 minutes per Sunday video on these, go through these extensively, but now just to be efficient on time, I'll be blasting through those rules. So if you want to see the long form version or the 10-12 minute version, they'll be down in the description. But let's go. Let's take a brief look at the strategy rules. Number 1, you want to build a watch list and filter for red. Very simple, guys. Since we're looking to write puts under the market, we want to be building a watch list filtering by red. I only look at companies that are red. Why? Because when they're red, it allows me to write even lower under the market, because we want to buy these things, possibly if assigned, at the cheapest possible price available. And if not, at least we get a hell of a discount to write those put options. So number 1, this is where everybody gets it wrong, guys. High quality, high conviction companies only. I will remind you, in this market especially, high quality, high conviction companies that you do not mind being assigned if you are going to be assigned. Now, if you respect the rules of this strategy, most likely you will not be assigned. But in the event that you have to buy those shares, it may as well be on a high quality, high conviction company, because the last thing you want is opening your portfolio if you get assigned those shares and wondering what the heck you're doing in that company in the first place. Number 2, monthly uptrends or long-term ranges. We want to have the long-term bulls at our backs, especially in this style of market. So we want to be targeting companies that are in a monthly uptrend or a long-term range. Number 3, we want to be not playing any companies that have earnings this week. You guys have seen it so far in the last 2-3 quarters. Companies can have great earnings and still go down 5, 10, 15, 20%. If you want to avoid any large losses, guys, do not write any puts on companies that have earnings this week. You may as well wait after their earnings are released, not before. Number 4, we want to be writing puts on companies that are at weekly support areas or areas of breakout retests. I'll just remind you a quick example of Autodesk. at a big support area. Could be something like this: 1.5 years worth of support, writing puts down here, decent opportunity. The breakout retest trade is otherwise known as the trend continuation trade. You can see a high end of resistance right here. Weekly uptrend gets put in place, breakout of the resistance, retest as support, and then the run. So that is the retest area, very high probability trade. All of my trades that you'll see moving forward are going to be either one of those two scenarios, either at support or a breakout retest. Number 5, writing at or lower than the expected move. Every time I'm looking to write put options, I take a look at the expected move, guys. If you don't know where to find it, you can go to barchart.com. Just type it into Google, bar chart, expected move, and then whatever stock you're looking for, it'll bring you to a page similar like this. This is Wall Street's expectations of how much a stock can go up or down depending on the options pricing right now in a given week. Here you can see Amazon for the week ahead has an expected move of 2.75%. I want to be below the lower end of the expected move. Why? Well, because if it goes down into the expected move or further below, usually throughout the week, we get a little bit of mean reversion and pulls us back up. If we're always writing below the expected move, we put the most amount of odds on our sides of not being assigned. Number 6, we want to be writing on a red or flat day. This goes with the previous point as well. If you're looking right below the expected move and Amazon just pops up 2-3% on the Monday morning, well, we're not going to be able to write below the expected move. It's going to be too high, and we're not in the business of chasing the market. So be patient and write on red or flat days only for your stocks. Now, before last, we were writing 0.5 to 0.75% in weekly premium. This is your weekly take-home pay, guys. If you're always getting 0.5% per week on the capital for this strategy, 52 weeks in a year, that would be an average return of 26%, no compounding whatsoever, right? Very nice baseline return. After running this strategy for the last 7 years, this is the sweet spot. Anything more than this, your risk of assignment is too much. Anything less than this, the ROI is just not good enough. What do I mean by the 0.5% rule? Very simple. A lot of people like to use delta. I don't like to use delta because the deltas on, if you're looking at Coca-Cola or a bank or Amazon or MicroStrategy, are all going to be at different levels, right? So delta is not a very good indicator. If you want something that encompasses the different implied volatilities across the chains, you can use the 0.5% rule, and it's a lot easier than looking at delta, guys. Just do half of the strike price divided by 2, and that's how you know if you're getting 0.5% per week, right? So let's say 190 divided by 2 is 95. Here right now, we have $3 divided by 190. You're looking at just over 0.5%. But if you don't want to break the calculator up, just do half of this in your head divided by 2, and that's the amount of premium you need to see on that strike. This is going to be the sweet spot strike for the current week upcoming, right? And the trick is, if this sweet spot strike is lining up with all of these factors, then you know the trade is good. Now, lastly, we set a take profit order at 90% of the contract value, just making sure we're being capital efficient here, guys. If you write these options on a Monday morning and by Tuesday afternoon or Wednesday morning, it's 90% profitable, why would you hold it into the end of the week, right? You may as well take those gains and go shopping for a brand new play just to be efficient with your capital. And now, lastly, guys, if you are assigned, you want to be writing covered calls, right? This, selling a put, is to get into a stock at the lows. How do you get out of that trade? You sell covered calls, which acts as a sell limit order above the market. You're going to be looking for the same rules, 0.5% to 1% in weekly premium on those covered calls. And we are always, most often, writing at the assigned strike price or one strike price higher. You don't want to go too high, guys. Just focus on collecting that juicy premium, and that is going to be it for the strategy rules. Hopefully you guys enjoyed that. Now let's dive into the top 5 options plays, shall we? So first off, I have a pair of fintech plays, number 1 of which is going to be SoFi. The reason I like SoFi is the reason I've liked it for the past few weeks, coming down into our support range, 1170, down to 930. The valuation of SoFi is also quite good. You're looking at a 0.91 forward peg ratio right now, and price to sales is a 4.29. SoFi is also expanding on all its lines of business. It is now a profitable company too, and it has a secular trend of capitalizing on the digital banking structure that a lot of the younger generation seem to prefer rather than the legacy banks. All those reasons lead me to believe that this is a good bet with that support area combined. If you don't like SoFi, I have a ton of other stocks for you guys. This is just for people who do like SoFi, right? The expected move for the week is $12 $12.25, this yellow line right there. Let us see, can we find any premium below that, preferably into our support? So let's say like 12 bucks and below. So let's pull up the SoFi options chain and go shopping for those together, shall we? So let me just pull up SoFi right here since it's not there. SoFi, and let's go shopping on the chain, right? We want to be below 12.25. So think 12, 11.50, 11. So let's go shopping right here. As you can see, at $12, you're getting almost 1%, right? Now, you can go a little bit lower if you want to be a bit more risk averse. The $11.50 strike is paying 0.5%. Half of 11.50 is roughly 6. You can see you're getting roughly 6 cents right there. So it does respect the rules. But if SoFi drops on the Monday or Tuesday morning back down into here, well, then you'll get a lot more premium on those 11.5s. And if for some reason Monday is a terrible day in the markets and SoFi drops 5-6%, you might be even able to find the 11s. You guys getting the point, right? You want to go as deep as possible. Whatever the move is, you want to get the lowest possible strike while still getting the 0.5% rule. Be dynamic with your strikes, guys. Depending on the percentage drop, look at the options chain and see how the premium moves. Obviously, you want to get the best possible price, the lowest possible price, while not sacrificing any ROI. So make sure you do that. Stock number 2 of the fintech pair is going to be PayPal. Now, I know some people have their concerns with PayPal, and for a long time, I did too. But especially, I did not want to play it up here where the valuation was getting a little bit stretched, but down here at $70, we have to look at that valuation again, right? PayPal, you can say what you want about the company. They have a large customer base. They are improving EPS. They've been improving their profitability under the new CEO as well. As you can see, profitability has been steady and somewhat improving, and the revenue growth is also not fantastic, but they are growing as a business overall. Suffice to say, their forward PEG ratio is 1.09. Forward price earnings, 13.9, very cheap, and their free cash flow yield is 10.2%. Those are arguably fantastic numbers. Up here at 90 bucks, not so much, but down here at 70, coupled with very large support from the last 3 years, does mean that this play is now in the opportunity zone once again. I was patient with it. You might remember I was playing it a ton back here. Now it's giving us the opportunity again. So the expected move for the week right now on PayPal is 68.24, not that far away. Let us go shopping to see, can we find some premium on PayPal, preferably deeper into the support range, as we just come out of daily oversold, but any move further down, we'll get right back to daily oversold. And you guys know, I love playing those stocks when they're daily oversold, especially, guys. Let's take a look at PayPal's options chain to see what we can find together in terms of premium below that expected move, shall we? So I'll remind you, 68, below 68, yeah? So you can see below 68 here, well, unfortunately, there's not much. At 68, there is 0.5% at least. Half of 68 is 34. This is how you can go through a ton of options chains really fast without having to look at delta, guys. You can just divide this by in your head, and if it's not there, it's not there. You just move on to the next play, right? Preferably me, guys, I would really want the 67 to 65 strike. I know I'm being a little bit greedy, but in this market, you kind of have to, right? At the 67s right now, there is not enough premium, so this would not fill the trade's criteria. However, if on Monday morning, the stock moves down into the expected move or even lower, that is probably going to free up my favorite strikes, which are the 67 to 65. I would really like PayPal to drop a little bit so I can fire off some 65s, but we'll see how the Monday and Tuesday sessions go. I do like this support range, guys, but the name of the game is getting those stocks. If you are assigned, you want to get them at the cheapest possible price, especially in this market, right? Don't be too greedy and play it too close. Wait for the market to come to you. If it doesn't open up, guys, and it just goes green, don't start chasing this one to the upside, please, right? And those are your 2 fintech plays. Now, plays number 2 are going to be a pair of semiconductor trades, 2 of the highest quality ones in the entire market. The first one is NVIDIA, and I've played NVIDIA a ton. I gave you this one last Sunday and took it myself when we opened up on the Tuesday session. I was able to get the 105 strike for 0.5%, guys. Right now, as of right now, the support zone has not moved. Still 111 down to 101. The valuation of NVIDIA right now is very attractive at a 1.1 forward PEG ratio for 2025 and only a 25 forward PE ratio. NVIDIA, suffice to say, is very cheap. At the end of the day, it's one of the best tech companies out there right now, at least for the next 2 years, in terms of their impact on the AI landscape overall. That is very clear. The expected move is 113.45 for the week. So let's go shopping on NVIDIA. Maybe we can find something in that support range, right? Because we want to be below here, preferably down into the range. And maybe we can even get the same one I got last week at the 105, which is a very easy trade to make. So let's bring up NVIDIA real quick, shall we? So let's bring up NVIDIA and we'll go shopping together. NVIDIA has some pretty good volatility. So you are able to find quite a distance away. Now, at the current time, guys, you can see that the 0.5% rule comes in at 111, right? Half of 110, roughly 55. So that is where the premium is right now. And that is below the expected move by about $2, right? However, if NVIDIA on the Monday session drops into this level again, say it goes down into the expected move, 113, 112, even 111, be dynamic. Wait for the market to come to you, yeah? That may free up some even better strikes, maybe the 108, 107, 106. So for me this week, I really want to get in the 108 and below. 108 to 105, I'll be patient for it. If it doesn't give me a nice big red day, I'm probably not just going to take this one at all because it hasn't done much in the last 3 days, right? I need a little bit of volatility, and any move to the downside, a quick downswing, could open up some strikes down there. 108 to 105. I want to be getting NVIDIA as cheap as humanly possible. So those are my preferred strikes and how I want to play it, right? Be patient, because in this market, you know that, there's not a lack of opportunities, right? So you may as well be patient for the best ones. Second of them is TSM. Why do I like TSM? Well, their moat is undeniable, guys. A huge competitive advantage in terms of chip manufacturers, right? This company has excessively good net margins, 40+%. Their forward growth profile for the next few years is fantastic. Look at all this EPS ramp in the next 3 years and all that revenue ramp as well. Fantastic, fantastic company, guys. And the valuation is very cheap at a 1.14 peg on a forward basis and a decent free cash flow yield as well. Couple that with the fact that they are into support right now, roughly, right? 171 down to about 158. This is the area that I want to be playing TSM, especially when the market is giving us a juicy discount right now of 20 to 24%. So the expected move for this week on TSM is 171.32, the bottoming out area of the last 2 weeks. Let's go shopping on TSM and see, can we find anything below the 171 strike? Let me pull up TSM right away and we'll have a look together. So looking at TSM right now, you can see we're looking for below 171. Look at the 170s. Half of 170 is about 85. You can see right now, we are getting at least 85 cents on the bid right here. So that would respect the trade criteria. However, if TSM drops on the Monday morning or Tuesday morning, if you're watching for it, if it drops a little bit, you may be even able to get an even better strike. Think of possibly the 167.5s, or if the market has a very bad day Monday, as it could, who knows, right? Maybe you can even find the 165s. You want to be going as deep as possible in this range to make sure that if they do assign you those shares, you have the best possible price within this whole support range. That is how I'm looking to play TSM myself. Those are the two semiconductor plays. Now, play number 3 is one that you guys know very well. And of course, it's the big one, Amazon. So Amazon needs no introduction, guys. I'm pretty sure you know that they're going to be having a very profitable future. Their PEG ratio right now is a 1.49. Forward price to earnings is finally below 30, which seems high, but this is actually one of the cheapest valuations that you've been able to find Amazon in the last few years. Their future is looking very bright, fantastic EPS expansion for the next few years, and a fantastic revenue expansion curve as well, as they continue to focus on shareholder profitability, guys. Increases in free cash flow, increases in EPS, and increases in net margins. Amazon has never done that before. They've only been a top-line revenue growth company at all costs. Now they're focusing on the shareholders and could be delivering fantastic, fantastic shareholder returns in the near-term future. That being said, we are also at a very nice level of technical support, prior resistance, current support for the markets, and on the daily time frames, we're just oscillating at daily oversold. And look at this MACD. Looks like it wants to cross, right? So we may as well make the most of it while Amazon is still low down here, and try to play some short puts if we want to just play some premium. And even if we acquire some shares, it's a tremendous discount on Amazon. Would be down about 21% from the all-time highs, yeah? The expected move for the week is 190.82. Let's go shopping on Amazon and see, can we find anything below 190, right? So taking a look, half of 190 is roughly 95. So you want to see at least 95 cents. This was the example earlier on in the video. As you can see, the 190 strike is paying some adequate premium right here. However, if Amazon chooses to drop on the Monday morning session, I got a fantastic, fantastic contract when we had this drop on the Tuesday session. I was patient. I waited. I was able to get all the way down here, guys, in the 180s. I went with a bit longer time duration, but if you're doing weeklies, the logic is the same. Be patient, wait for a red day, and then you can get some best prices, right? Now, if Amazon drops on the Monday or Tuesday session, maybe you can get even better than the 190s. Maybe the 187.50s. Maybe if Amazon has a 2-3% day, maybe you can find some good premium even at the 185s. So for me, it's going to be one of these two strikes, guys. 187.50 or 185 for the week. I would be very happy getting some Amazon shares at those quite low levels and very decent valuations. That is stock number 3. Stock number 4 is another one that needs no introduction, and it is Google. Now, I know Google has had its host of problems in the recent history, right? Some people say that they're losing their search dominance to large language model chatbots. Some people say they're losing their advertising dominance. Some people say that the Department of Justice has a monopoly antitrust lawsuit with merit against the company. One thing's for sure, though, all of those things are largely priced in at this point. Forward price to earnings, 18.5. That is under the S&P. Forward PEG ratio is a 1.23. Fantastic net margins, fantastic growth in cloud revenue, and insane levels of free cash flow, guys, right? Very nice net profit margins. And Google, despite what people say, will be growing EPS for the next 4 years and growing revenue likely as well for the next 4 years combined. Fantastic company at a fantastic price and in a very, very large area of overall support, which has proved to be a nice area of defense for the bulls since all the way back since the month of April 2024. So I want to take advantage of it when Google is down here. Keeping in mind, the expected move for the week right now is 161.87. Let us go shopping. Can we find any premium below on Google below 161? And even if we want to have a DCA approach, right? If we get assigned some shares here and we have the capital, I would not mind buying even more Google down there as the valuation gets cheaper and cheaper and cheaper for this company that's already off the all-time highs by about 21%. Let's go shopping on Google, shall we, and see what we can find. So taking a look at the Google options chain, can we find anything below 161.87? Well, let's have a look, shall we? At 160 right now, half of 160 is 80. You can see that we're just a little bit short on the premium, and 162.5, although the premium is good, well, it's above the expected move, so it breaks one of our rules. Essentially, what I'm saying is you have to be a little bit patient on Google right now. If it has a drop on the Monday or Tuesday session down into the low 160s, that is probably going to be the time to strike when the iron is hot. That being said, we'll be looking for 160, but if the move is really a big red day like we had last Tuesday, if you got anywhere last Tuesday, guys, you were able to find the mid 150 strike, which was easy money in my opinion. If Google does the exact same thing early on in the week, you may be able to find the 157 strike, maybe, who knows, even the 155s. Last week, it didn't seem plausible on the Monday session, but come Tuesday, they gave many entries for those 155 strikes. So those are the ones that I prefer, guys. In the 157 to 155 range, be greedy with this market, guys. You never know what you're going to get, so you may as well be patient, yeah? Don't play it too close, because you know that the next red day is probably just around the corner, yeah? That is stock number 4, and stock number 5 is going to be one that I haven't played for a while because the technicals just weren't right, but now they definitely are. This one is Uber, right? The reason I like Uber, guys, is you can say what you want about their network effects, about robotaxi, possible impact, but the impact of robotaxis, guys, is like years and years and years away. Yes, Waymo is doing a ton of rides in the United States, but that is only one of Waymo's markets. It's a very small market for them as well. They're only in a handful of cities, right? Uber has almost arguably worldwide network effects at this point. Their moat and their competitive advantage is years and years away from being challenged. At this rate, though, they're currently trading at a very nice valuation. Forward price to earnings of 28, a forward PEG ratio of 1, which is fantastic, and a free cash flow yield of 5%, which is equally as fantastic. Record free cash flows, very low amounts of debt, and the future does look bright for Uber, guys. You're talking about ever-expanding EPS. The company is now profitable, and ever-expanding revenue curve too. These are the styles of companies that I like. Companies with strong competitive advantages, decent moats, and trading at good valuations, right? We're not in the business of buying stocks that trade very rich. That being said, this is the infamous, right, breakout of a resistance range, huge range, retesting as support, and now looking for the run. However, if the bulls get a little bit of cold feet because the market overall pulls back, and we can find Uber in this range of support again, 73 down to 69, I think it's a very decent first entry position for Uber, or just to farm some premium in the support range overall. Keeping in mind the expected move is 73.40. Let's go shopping on Uber and see, can we find any good premium on Uber below the expected move? So taking a look, expected move 73.40. Let's have a look at the options chain. We're looking for 0.5%. Half of 72 is 36. Well, look at that. That is literally the price for the 72s, which are below the expected move of 73.40. So at a first glance, 72 is not bad. However, keep in mind, Uber had a big green day on Friday. If they give back a little of that in the early portion of the week, come down 74, 73, you might be able to get even lower, guys. Think 71 or 70. I want to be getting as close as possible to the $70 strike while still getting roughly 35, 36 cents as deep as possible into this support range to give the bulls the best chance of playing some short-term defense and our contracts expiring by the end of the week worthless. Or if we have to buy the Uber shares because it drops lower, at least we're getting them at the best possible price on a weekly basis. Those are your top 5 options plays for the upcoming week. Hopefully you enjoyed that. Now let's get into some bonus plays, shall we? So in terms of the bonus plays, it's not that they're not as good as the top 5 options plays. It's just some of them are more volatile, or some of them are just not ready yet. They're coming down, but just not yet within striking distance of where I really want them, okay? Let's go through these. I'll go through these quickly. I won't be giving the expected moves pretty much, but I'll give you guys the levels. You guys are now pros, so you guys can look for the expected moves on your own and price out the contracts on your own as well. Stock number 1 is going to be TLT. For those of you that want to play defense, want to acquire a little bit of bonds, what better way to do it than writing puts in the market? TLT, fantastic area of support, guys. 89 down to $88. If you see a recapture in the bond play right down here, you can choose to write some short puts to enter those trades or just to farm some premium, right? And in the event that you get assigned those shares, you're getting a 3.69% dividend. Very easy play on 20-year bonds overall. The second one has to be something like an IAUM, or if you want to play another gold ticker, GLDM. These are 2 smaller tickers for gold for those of you that don't have very large accounts, because we know the big gold ETF is like $27,000 of capital for 100 shares, yeah? So if you want to play the smaller ones, take a look at IAUM on a pullback. Use the actual gold ticker, guys, as your guide, right? XAU USD. If we can pull back on gold a little bit this week and you can find anything under 3,000, right? Pull back into here. Let's call it 2950. That'll be synonymous on IAUM down here in the $29 range for all of you that either want to play gold on a weekly recurring basis to farm some premium, or if you want to play this ticker, GLDM, right? That would be in the $58 to $57 ranges. That's just for the people that either want to play this for weekly options wheels, or if you're looking to acquire some shares lower than the market and getting paid for your time, it's a great way to enter some of those gold trades that are not very expensive overall for 100 shares. And then after you can write covered calls on them the whole way up, right? Stock number 3 is going to be Elf Beauty. Elf Beauty, I like this one. Maybe you don't like this one, but I really do. 24 consecutive quarters of over 20% sales growth. The valuations are extremely, extremely cheap for this company. They've been caught up in some lawsuit headlines, the tariff headlines as well, which means that their stock is now completely almost de-risked and into support, 64 down to $50. If I can find some short puts down here in the lower 50 range, I will oblige and trade those contracts because there's some great implied volatility on them and we're weekly oversold, right? Stock's gotten crushed. Now it's at a very reasonable valuation, and I think it's a very good play overall. Stock number 4 is going to be Pepsi. Pepsi, one of your value and defense plays coming into support. What kind of support? Very big support. The highs of 2020 and 2021 overall. So keep that in mind. We're now there. That's where the bulls reacted from a few weeks ago. And we are now back there again. If I can find a lower 140 strike on Pepsi, that will be a fantastic play to position. It's more of a defensive company. And we know there's been some sort of rotation from growth to value recently, so Pepsi may not be the worst play out there, paying a 3.73% yield. Moving on to the stock number 4, stock number 5 is going to be UPS. So FedEx just had their earnings. UPS does not have earnings until the end of April. That being said, we have to be a little bit greedy with UPS because we know that the consumer is not in the best position right now. There's macroeconomic risk. the tariff risks, and everything else in between. So if I'm going to play UPS, I want to get the best possible price. It's on my watch list. If I can see premium down here, 105 down to about $100 into the deeper ends of this whole support range, which is, guys, that is literally like 2014 to 2019 or even 2020, right? 6 years worth of support. If it comes down here, I'll probably write some short put options on it. It pays a 5.7% dividend overall. Not looking too bad there. Stock number 6 or 7, I have no idea how much we're on right now. I'll just say the next one is, so Microsoft, those of you that have a larger account and want to play tech, but maybe one of the more defensive and you're just one of the best tech companies in the world, Microsoft, very high net margins, guys. Forecasts here for the next few years, EPS growing, revenue growing. The last bear market of 2022, did they drop EPS? No. Did they drop revenue? No, right? So Microsoft at the end of the day is Microsoft. It's been in a range, guys, for the last year while improving their fundamentals. And now we're at very decent support, 380 down to 365. If I see some premium down here, 380 to 365, very decent entry opportunity for Microsoft, all things considered. Now, the next one is going to be more of a defensive play as well. A railroad company, right? Even Warren Buffett has some of these. Moving on, guys, coming into the lower end of support, where I want it, 72 down to about $65, as deep as possible. It is a literally four-year range of support. So I do not think they're going to break that just yet. And in terms of the fundamentals, guys, the fundamentals are very strong. This is almost a duopoly with a few other railroads in America. EPS will be expanding nicely over the next 4 years. Revenue as well, expanding nicely. Nothing wrong with this company, just a very long accumulation phase, a very defensive company overall. Speaking of another defensive company, MO, right? Tobacco company. Its competitor, Philip Morris, is well onto the all-time highs. Do I want to chase Philip Morris up here? No. But do I want to possibly play MO where it's closer to a level? Big resistance range for the last, 4 or 5 years, and at this point, it is now a breakout, retest of a support range, and maybe run. If I can find MO again, $55, $54, I may oblige and play some short put options. Another one is Toast. This is a very cheap software company overall. If you guys have ever used Toast's software at restaurants, possibly, very good, guys. They're expanding revenue and EPS in a very nice fashion. They're also coming into profitability on the company, but we have to be wary. We want to get the best possible price. This is a breakout retest, guys, on a monthly time frame, yeah? Monthly uptrend, breakout of a big range of resistance. If I can find, and you guys saw me play this one a few weeks ago down here, if we can have another leg down and I can find Toast $29 to $25, I'm definitely going to pull the trigger on this fantastic company. The next one is the China plays, KWeb. We know KWeb and the Chinese companies have been very hot. If you don't want to have company-specific risk, maybe you can choose the most popular ETF of them all, which is KWeb. Reacting from resistance, supports down here, $32 to $30. It was resistance, guys, for a very long time, at least the last 3 years. If we get a revisit, you guys know the drill, the breakout, the retest, and then maybe, can we get an extra leg of run? So if it does come down here, 32 to 30, big fan of playing KWeb. It's just a little bit too far away, but on any pullbacks, it could give us some very nice opportunities to play puts, or short puts rather, into the market. Moving on further, some oil plays. Why? Well, because oil is coming into bullish seasonality. This is a 20+ year range on oil. Think of all the geopolitical events, all the just political events overall. How many administrations has this chart been through? You can even go back 30 or 40 years. Oil always has the same seasonality. In the spring and summer, the Northern Hemisphere, which is responsible for a lot of domestic and international travel, the travel starts coming alive. Not only in North America, but in Europe and other places alike in the northern parts of Asia, such as half of China and also half of Japan, right? Very large economies there. Number 2, agriculture season. That is why. There's a couple other factors at play, but suffice to say, spring and summer usually has the highest demand for oil overall. Whether you're in, this chart has gone through bear markets, guys. We went through 2022. It's gone through the pandemic, which was a bit different. It's went through 2018 and everything else. It's even went through the great financial crisis, and oil still has the same seasonal pattern. That being said, if we're looking to play oil companies, probably want to play one of the best, which is XOM, but it's a bit too far, right? If we can get another 106 down to 100 on ExxonMobil, that pays a 3.43% dividend, not a bad location to be playing oil stocks in the face of the most bullish period of the year for that style of company, yeah? Moving on further, we have another style of company, which is Suncor Energy. Same concept, right? Another energy company into bullish energy seasonality right now. 32 down to about $30 is where I want to get it. It's a little bit too high. You can make an argument, yeah, but Will, you know, we're above that previous resistance range into support. I know, but on these companies, guys, I'm looking to get the best possible price. If for ever reason Suncor comes down, is this not a much more reliable level, right? How much is that? Like 15 years worth of price action. I'll be patient. If it doesn't come to me, no problem. There's tons of other stocks on this list, right? Another one is TD Bank. If you guys like the banks, the only bank that I find in decent support range right now is TD Bank. TD Bank, 58 down to about $53. That is the area that I'd like to go shopping. And this one pays a 4.85% dividend. Fantastic bank overall. It's one of Canada's big six. They also have a number of, institutions or, just lines of businesses in the US as well. So multinational in that respect. Very nice area of support and a very nice dividend yield. I'm not in the business of chasing other banks when they're up here and on a short-term pullback, right? No. I want something that's in a big area of historical support overall. Lastly, we have McDonald's. McDonald's, another solid play. This is a categorical, just a breakout retest, right? Breaking out of the all-time highs, maybe retesting the all-time highs, but it's not just ready just yet, yeah? If we come down a little bit more and I can find some strikes on McDonald's, 290 to 280, a little sweet spot right there. That is the area that I'm going to be choosing on McDonald's. The monthly time frame shows it best. Yeah, monthly uptrend. If we pull back into this area again, I'll be looking to play this zone of congestion, 290 to 280. So it's not ready quite yet. And now a few last ones, guys. Palo Alto Networks. If you guys like the cybersecurity companies, what better one than Palo Alto? Very strong company, but not ready just yet, guys. I want 170 down to about 160. Now the valuation is quite high, but these companies are growing at quite fast clips as well. CrowdStrike 2 has a somewhat rich valuation overall, and we're just looking for this whole big monthly level that's acted as support for the last year. Palo Alto Networks, not a bad play overall. And lastly, but not least, Airbnb. Airbnb has had its challenges over the last few years. The company is focusing on profitability, focusing on generating good free cash flow yields as well. At 127, the valuation is not the cheapest, which is why I want to be playing it down here. 120 to 115, the bottom end of this last 2+ years of support at this point. So don't get too greedy, right? Chasing it to the upside. Be patient, let the market come to you. If it gives another opportunity, 120 to 113, I would not be opposed to playing this stock as well. And those are all of your bonus plays, guys. Hopefully you're able to find some ideas within those. And if you appreciated them, consider dropping a like on the video. Consider subscribing to the channel as well. We do these every Sunday in preparation of the upcoming week. And lastly, if you have any questions on the strategy, please feel free to leave your questions down below. Now, in the event, guys, that you wanted to have access to my private trading group where I share all of these wheel trades live, the link is down below in the description. Over 150 members right now, all trading the exact same strategies, all focused as well on long-term investing and consistent, just building up those consistent wins. It's a phenomenal market for selling credit. And not only do we do the wheel strategy, we also do a number of other strategies, right? Long-term swing trades with shares, call debit spreads, put credit spreads, any type of spreads, really, if you want. We do leap call options when the market is, favorable to them as well. So a lot of different strategies that we employ, but the bulk of our trading is done using the wheel strategy. Here are all the trades since the inception of the Discord, yeah? The green check marks are wins, the red circles are losses, and these are targets are assignments. These are all the trades, guys, since the inception of the Discord about 6-7 months ago. Usually very, very consistent in the types of trades that we take. Not too aggressive, just very consistent and somewhat conservative as well. Very patient in terms of trading style. So those are all the trades. We also do private morning live streams Monday to Friday, where I trade these strategies live with you guys for 2 hours from the open and thereafter. I also answer all your questions on your stocks, your options, your long-term portfolios live. And if you cannot attend, they're always recorded thereafter as well. Or you can gladly ask me all of your questions in our different chat rooms throughout the day. And I'm very, very fast to answer on those. We also do private videos on a number of other option strategies that I don't share on YouTube, more advanced stuff overall, how to grow accounts depending on your account size, small, medium, large accounts. What strategies should we be using at every level of account size? the portfolio breakdowns, right? What percentage of the account should be using the wheel strategy? What percentage should be either shares or call options, leap call options, call debit spreads, things like that, and a number of other different videos too that our members have been finding tremendous value in as well. And lastly, you get all of my watch lists, all the options watch lists that I use for this strategy, the other watch lists that I have as well, all my technical analysis too. So whenever I have technical analysis on charts and annotations from earnings on over 100+ different companies, you literally just copy paste, click 2 buttons, guys. You get all my watch lists and all of my annotations and technical analysis too. So that as well is a feature of the Discord. If any of that sounds good to you, the link is down below to join in the description. And if not, I guess I'll see you back on the channel, guys. Thanks so much for watching. Pleasure as always. I hope you guys have a fantastic week of trading in the markets. And always remember, be patient, guys. Let the market come to you, right? And that is what I'll leave you on. Take care, guys. Love you as always, and peace.